We just worked through a lot of numbers for 8-27. We worked on variable overhead analysis, a fixed overhead analysis. We should put the pieces together so that we could see the big picture. And I'm going to do that right here. So it's a 4 variance analysis. We've got variable overhead. We've got fixed overhead. Let me just give myself a little bit more room. We have a spending variance. We have an efficiency variance. And we have a production volume variance. Not every overhead variance has all three. Actually, neither one has all three. For the spending variance, it turned out to be $17,800 unfavorable for variable overhead and $13,000 unfavorable for fixed overhead. And if we take a peek at the numbers, here's our fixed overhead variance. And you could see spending-wise, our actual costs were more than the flexible budget. Even this budgeted lump sum, we had budgeted $360,000. Our actual costs were higher. We spent more than we should have. Now, this piece here I'll tackle in a moment. This was purely a production volume variance. This was purely because we made 4,400 units when we budgeted 4,000 units. So that part was favorable. But this piece here, in total, our fixed costs higher than what we had anticipated, and that is why it's unfavorable. If I go up a little bit and we take a look at the variable cost, the variable overhead, here we spent more than we expected to. And here's where you could look at the unit, or the hourly rate, I should say, and you could see that we spent $8.63 an hour when we thought we were going to spend $8 an hour. So that's unfavorable. That's a spending variance. As long as I'm over here, let me grab the efficiency variance, $16,000 unfavorable. You will only see an efficiency variance for variable overhead. So in this case, it took us more hours than we anticipated, 6.45 hours just to make one when we thought it would take 6 hours. So we were not very efficient, and it came out to be a $16,000 unfavorable variance. Let me copy that down below. Never a variance, because fixed overhead, that is a different animal altogether. It's fixed in terms of numbers, in terms of totals. We're not dealing with an efficiency variance in that case. What we are dealing with instead of an efficiency variance is a production volume variance. So never a variance when it comes to variable overhead. But for my fixed overhead, I had a $36,000 favorable production volume variance. And that is because we were at overcapacity. We made more than we expected to. So putting all the pieces together, you get to see the bigger picture. Reasons for variable overhead variances. Well, on page 294 of your book, we can see some possible causes and what management should do as a result. And these have to do with the efficiency variance. Here's the example in your book. And this section is dealing with efficiency variances. So for instance, workers weren't efficient. Well, in using the machines, could be scheduling issue where they're using more machine hours. Maybe the machines are not maintained and they're breaking down. Maybe we had a rush delivery and it just took more time than budgeted. Now, it could be that this rush delivery resulted in more sales for us, and that actually was a good thing in the end. So you really can't look at each one of these in isolation. You'd have to look at all of them together. Maybe the standards are off. That's always a possibility. In terms of spending variances, that's a little bit more, that's pretty straightforward. That's when we paid more than we expected for something. And let's take a look at our numbers. Variable costs, we did spend more than we anticipated. Maybe there's been a price increase in some of the overhead costs. Could be a number of reasons for a spending variance. What's a little bit more challenging to interpret is fixed overhead and variances. These are challenging because of the nature of the costs that we're dealing with. Fixed costs by nature, they're not very flexible. Sometimes we're dealing with them, or they're pretty much set years in advance, because we're really talking about infrastructure. So they may be difficult to change very quickly. And despite all this, you might notice that we still looked at fixed costs kind of as similar to the way we did variable costs. And this $15 here, it's not a real number. It's not the way fixed costs work. But when we're doing variance analysis, it almost seems like we're dealing with an hourly cost or a unit cost here. So it's a little bit of a contradictory issue. But it may be that we can't change things so quickly. So you got to be a little bit careful when interpreting fixed overhead variances. They're a little bit more challenging to deal with. Journal entries. For those fixed overhead variances, I need to journalize them, and that's what I will do here. If you take your actual costs, let me go back to the information that was given to us. Put this where we can see it. and this is for variances. We actually spent $373,000 in fixed overhead. So I will record that. Fixed overhead, control account, $373,000. Credit will go to things like wages payable, accumulated depreciation, etc. $373,000. At the end of the year, or at the end of the accounting period, I am going to allocate my fixed overhead. And this is where we tie back into earlier chapters, because we did this a while ago. It goes into work in process, and it's going to leave fixed overhead allocated. And we worked out that number earlier, $396,000. Coming right from here, we're allocating it based on what we actually produced. Everything else is a budgeted number. So that will be $396,000. $396,000. I also have to close out my accounts. So I will do that as follows. Fixed overhead allocated. I'm closing out my $396,000. Let me skip 2 lines and let me credit my fixed overhead control account. And that was for $373,000. So I'm closing out these 2 accounts. And I've skipped 2 lines because we've got $13,000 appearing in this column. And we've got $36,000 appearing in this column. And you could probably see where they come from, because if I go up a little bit, $13,000 was the spending variance. It was unfavorable, and that is why it's a debit. $36,000 was the production volume variance. It's favorable, and that's why it's a credit. And that's how we record the variances. So fixed overhead spending variance, fixed overhead production volume variance. Anything that's, this is not exactly scientific, this is just D'Aquila's brain working, but any time I see a variance as a debit, I think of it similar to the way expenses work. This seems unfavorable to me. Revenue, we always record as credits. This seems favorable to me. It's not what you'd see in a textbook, but that to me is a way for me to figure out, do I need a debit, do I need a credit? But those would be my journal entries to record all of this. And that wraps up this chapter or this problem.